Good morning. This morning we're talking about Zip. Zip is a buy now, pay later provider. Has already conquered the Australian market and is about to continue what has been a spectacular period of growth. We look at the fundamentals, a $4 billion company. Obviously, this kind of financial company isn't going to have a great deal of stuff. Sorry for the technical language. But the debt to equity ratio might look something to worry about. But obviously, well, perhaps not obviously, this kind of company is about burning money to establish itself and reaping the rewards later. The significant thing is that you will see here that Zip has penetrated the United States, and it is the United States market that holds most of the potential for future growth. Here are the financials. As I said, the financial situation of a company like Zip, which is providing essentially an intellectual property product without any physical product to speak of, is not going to be a standard sort of picture when you look at it when the company is establishing itself. I say the company is establishing itself. This is the full chart. You can see that the company started back in 2010. Had a very long period of development before taking off in 2019. COVID hit, and as with a number of companies we're going to look at during the year, COVID turned out to be a great boon for Zip. Everyone was stuck at home shopping online, and buy now, pay later was the perfect product to facilitate the lifestyles we all led during COVID. What we're focused on, obviously, is what's been happening recently. This is the spectacular growth of Zip over the 12 months between November 2023 and November 2024, starting from a price of a bit over 25 cents. It's grown to a price of $3.50, which is about 1,300% growth. It is exceptionally significant, especially when you look at the full-term chart. What you're seeing here is the company maturing in value, having been drastically overpriced during the period both before and after COVID. While the market was finding its true value, this growth is made in the knowledge of this full trading history. What we see when we look at the primary indicator, the MACD, is that for the basic reason that I only recommend investors buy stocks when they are below the zero line here, this is a stock that I've been waiting all of July, August, September, October, November and December last year to recommend a buy, because the last actionable buy point was back in June last year. This is not at all uncommon, but when a company is growing, you will see that the likelihood is it is going to stay below the zero line. There are arguments, I suppose, for buying during this period, but what goes up must come down, and if you do buy while the MACD of a stock is above the zero line, you stand the chance that you're going to buy just before this kind of decline. What this kind of decline presents is an opportunity to buy into the stock. I thought that the opportunity might have passed once the buy point in December became real, and I recommended a buy back here. But we've had a double dip, which isn't at all unusual, and as you can see, the stock is once again at a buy point. What led me to retrace myself to talk about this stock was this interview with Pendal's Rachel Thalder.
Okay, well, let's get into a couple of ideas. We're going to start off with growth. What's a company you think can deliver stellar growth in 2025?
So Zip would be my pick for growth in 2025.
Off the back of a big year.
I know, it's done incredibly well already, but I think they're just getting started. And I think one way to look at it is how the business has pivoted over the last 12 to 18 months. They've had a new CEO who's come in, Cynthia Scott. She's done an amazing job refocusing the business and exiting non-profitable parts and growing, in their core markets. So now as they refocus into partnerships, marketing, they should put themselves in a really good position to, grow customers. And it's really interesting. They've had an amazing growth year, as you say, but they haven't grown customers over this time. So I think that's still yet to come through.
So it's just a bit of a re-rate coming through.
Yeah, exactly. Yeah, and we still see the outlook for the US consumers being pretty strong, and buy now pay later penetration is still only 2% of the market. So there's a long way of adoption left to go.
Talking about breakout sectors, breakout industries, 2024.
So one of the fundamental premises of BuyPoint ASX is that it's kind of folly for a normal investor to busy themselves trying to do fundamental analysis of a billion-dollar company. That's something that's best left to the experts. And of course, what we all know once we start looking around the internet for information about investing, there are a heap of people doing that. More importantly, there are a heap of people working at Zip who are doing that. So the rationale here is simple. BuyPoint ASX is focused on the ASX 300. This is a measure to balance risk and reward. A lot of people have the view that the chances for real growth, the kind of growth that they want to see, spectacular growth, only lie with small caps. That might be true, but this is a matter of balancing risk versus reward. The market, as we know, if we pay attention, generally returns something like 8% growth per annum. What you will hear in the industry is that nobody beats the market, and that is the proposition that BuyPoint ASX has been established to challenge. One of the planks for the rationale behind BuyPoint ASX is that by limiting your attention to stocks in the ASX 300, you're minimising the risk while maximising the availability of high quality fundamental analysis that you can get for free. So what we're looking for is technical analysis that indicates opportunities for both long-term and short-term growth. With Zip, what you see is a company which has been long established, has found its true value, has a new market to penetrate, and has every prospect of returning to the kind of value levels that it has already seen in the past. So if what you're looking for is capital growth with a relatively low level of risk, then this is an approach that I think should be of interest to you. That's all for today. Have fun in the markets.